Every investor needs to understand each of these 4 concepts in order to grow their money and reach financial freedom. The first concept is all about where your profit comes from. And based on my almost 2 decades of professional experience, from my time on Wall Street to running an investment company here in Europe, too many investors don't understand this point. So to illustrate it, imagine that you are a criminal mastermind who knows how to print money. You take 1 full month to print €1,000,000 for yourself. Now, let me ask you this. By the end of the month, have you created new wealth in the world? Well, you individually are certainly wealthier. But is society as a whole wealthier? Well, of course not. Otherwise, the European Central Bank could just print €1,000,000 for every single person in Europe and we would all be rich. But if that actually happened, it would simply lead to enormous inflation. Money would lose its value. In reality, printing money does not create wealth. It redistributes wealth from society to the money printers. Now let's look at a second scenario. You are a talented software developer who spends the same amount of time, a full month, to develop a new piece of software for your client. And the client pays you €1,000,000. Have you created wealth? Well, you individually are €1,000,000 richer, so that's nice. But on the other hand, your client is €1,000,000 poorer. So in pure cash flow terms, it's a wash, right? But in this case, your client now also has a valuable piece of software. So the net result of your activity is positive. You have actually increased global wealth in this scenario. Now, there are some people who build their entire careers around redistributing wealth. Criminals, corrupt politicians, gamblers. But that's not just a miserable way to live, it's also risky and difficult. If you look at most financially successful people, like most everyday millionaires, they reached financial success by creating wealth, not by taking it from other people. And this is also the first concept that any investor needs to understand. There is a big difference between activities that create wealth and activities that only redistribute it. When you're a beginner, all forms of investing look the same. Stocks, bonds, options, forex, day trading, but they're really not. Now, the cleanest example of wealth redistribution would be foreign exchange trading, or forex. Because in forex, you make a bet that one currency, like the US dollar, will rise or fall against another currency like the euro. There's a good friend of mine, smart, hardworking guy, and he's been doing forex for almost a decade. Over this period, he's had some fantastic months, but he's also had some terrible months. Overall, he's made basically no money at all. Last year, he lost $16,000 that he couldn't afford to lose. Now, every time we talk about it, he agrees that he should really stop. But the next time we talk, he's trading again. I don't want you to get sucked into this kind of addiction. So let me explain 2 reasons why Forex and other similar forms of wealth redistribution almost never work. The first reason is mathematics. Wealth redistribution is, by definition, a zero-sum game. In Forex, if you bet that the dollar will rise, there needs to be somebody else who bets the opposite. One wins, the other loses, and the average player earns 0. But in reality, playing a zero-sum game takes significant time and effort. It takes money. You've got to pay taxes and brokerage fees. And after you take all of that into account, the average result becomes negative. The average trader will always lose money. This is inevitable just because of the math. All right, but you might say, well, sure, the average Forex trader loses, but I'm not average. What if I'm smarter than everybody else? Or what if I buy a super cool trading course from my favorite guru? Well, here we come to the second reason why wealth redistribution is a bad strategy in the financial markets, which is demonstrated by decades of data. Millions of smart people have been trying to come up with clever trading systems since the first financial markets were created. With all the effort and endless hours they have devoted to this activity, you would hope to see a meaningful percentage of them become skilled and get good results. But every serious long-term study of traders, like this one, or this one, or this one, shows that the vast majority either lose money or underperform market averages. And by vast majority, I mean as much as 97 to 99% of traders lose out. And the few who do succeed typically don't stay successful very long. So this is why Even if your favorite trading guru actually was a profitable trader once and isn't just really good at photoshopping profits, they are now selling trading courses instead of making millions in the markets. The reality is the financial markets are complex. In the short term, the prices of currencies and stocks and commodities like gold move up and down close to randomly. The smartest person on earth could analyze price charts for 100 years and still not learn how to predict them. So the second concept that you need to understand is that in the financial markets, wealth redistribution is not a reliably winnable game. This rules out not just Forex, but many popular activities like day trading, CFDs, prediction markets, options trading, and more. Now, instead of wealth redistribution, you want to participate in wealth creation. And this brings us to the third concept that every investor needs to understand, which is all about who benefits when wealth gets created in our world. I grew up in a hardworking family in Eastern Europe. My parents are teachers, and they taught me, if you work hard, you will do great in life. And of course, that's a good lesson to teach a kid. But as you grow up, you realize working hard only gets you so far, right? I mean, many of the hardest workers out there earn a low income and struggle to build any kind of savings or wealth. When I got a Wall Street job in my 20s, I entered a new type of social circle. And I met many wealthy people who didn't seem to work all that hard. It seems unfair. And arguably, it is unfair. I mean, this is what Karl Marx was complaining about long ago, right? But the reason why this comes down to basic economics. To produce something, to create value in the world, you need inputs. You need labor, yes, so that's work, but you also need land and capital. So after value is created, that's also who gets paid. Labor, land, and capital in various proportions. Now, most of the income in the global economy actually goes to labor. While the labor share of income has been falling, today in most European countries, it's still well over half. But the problem is, there's billions of people competing for this labor share. I mean, if you ever need a reminder, just go on LinkedIn and see all the competition you've got in your profession. So, if you want to build real wealth, it is in your interests to participate in the other side of the equation, to earn some of the income that goes to land and capital. So that's the third concept that you need to understand. Half of global wealth goes to the owners of land and capital, and investing simply means joining their club. You save some money, you buy some land and capital of your own, and then you get rewarded for sharing these resources so that companies and individuals can use them to create economic value. Which brings us to our fourth and final concept, which is all about identifying the best investments to use. When I first decided to start investing 19 years ago as a young banker on Wall Street, I really struggled with this. I was totally new to the markets and I had no idea what was a smart investment. But eventually, my boss at the time helped me figure out that the answer is quite simple. The best investments provide the economy with either land or capital. I mean, the most obvious choice is to invest in companies. So basically to buy shares or stocks on the stock exchange. This is the cleanest form of providing capital to the global economy. But there are many alternatives, such as lending companies money, for example, by buying company bonds. Or you can buy some real estate and rent it out to a company that's going to use it in its business. And then there are more indirect investments, like buying real estate and renting it out to people who need somewhere to live. And then they're going to pay you out of the income they get by providing labor to companies. Or you can lend money to governments, which provide the infrastructure that is necessary for companies to be able to create value. All of these investments can be very profitable because they help create wealth instead of just redistributing it. When you look at centuries of market results, there are only three major types of investment that have been the most profitable. It's stock investing, lending, which also includes bonds, and real estate investing. Now, in my personal view, for most beginning investors, there is one fundamental investment that stands head and shoulders above the rest. This is the primary investment I've been using to build wealth for myself and my family over the past 2 decades. It's investing in stocks. Because when you buy shares in a company, you own part of the company. You're participating directly in the global economy. And over time, that really adds up. So if you live in Europe and you want to learn how to start investing in stocks, you should watch this video next, where I explain everything step by step.